Do you ever wonder how big developers underwrite their files and analyze deals? Well, in today's video, Erin and I describe exactly how we show these types of developers how to finance their properties, all the way from acquisition to stabilization. Stay tuned. All right, guys, Josh and Erin back for their Finance Friday. And in today's video, we're going to actually outline what we do for a client when you guys come to us with a multifamily deal and how we go about analyzing it, what we give to you, and what you should be looking at when you're analyzing this deal. So let's dive right in. First things first, there's two ways to purchase a multifamily building. Erin and I talk about this all the time. First is buying an underperforming building, probably the most capital intensive thing you could do, but this is where all the money's at. Number two, buying a purpose-built multifamily brand new stabilized building. This is a great place to keep your money, to have consistent gains, consistent growth, and get some cash flow. For the purpose of this conversation, we're most likely going to focus on purchasing an underperforming building because a lot of our clients come to us and they are looking to generate wealth. So let's dive right in. What's the first thing we look at, Erin?
First thing we're going to take a look at is just the general structure of your deal. Who's going to be on the project? Is it going to be yourself? Are you bringing on JV partners? Are you in a GPLP? Like, what kind of structure is it, and how is that going to impact your deal moving forwards? Because we want to make sure the deal structure makes sense. After we figured out how you're purchasing and what the deal structure is going to be like, we're going to take a look at the asset and your game plan moving forwards, and is it going to be a viable solution? Just because you're buying a building and maybe there's a couple tenancies in there, or you plan on doing cash for keys, doesn't necessarily guarantee that that building and that project is going to make sense long term. You could be undercutting your numbers or over exaggerating your numbers, or not taking into consideration enough costs and fees throughout it. So the first thing we're going to do, take a look at the deal in itself, the structure, the building, the project, the long-term plan, and figure out, does it make sense, and is it even viable to keep moving forward throughout the transaction?
Yeah, our job is to help guide you through the process. And usually when you're purchasing an asset like this, there are multiple steps in that process. You may have a game plan, a goal, a vision for how that building is going to operate at one point, but our job is to align that with the financing option that's available to ensure that your expectations and what you want to do aligns with the capital that you have. Because if you have high expectations, but the capital doesn't necessarily meet the requirements, it's not a great fit. So our job is to really just determine what kind of capital is going to work within the confines or constraints of the deal that you currently have. So, realistically, what we're going to do is we're going to give you a ton of options. How does your building currently operate right now as is? Does it operate with conventional financing? Odds are it probably doesn't. It's an underperforming building. Commercial multifamily debt is really expensive. The debt servicing ratio is too high. And realistically, you have a massive down payment to get into something like this. Now, some of you might want that. It lowers the overall cost of borrowing. There's less fees. And you have, neutralized cash flow as you're turning over, increasing efficiencies of the building. Realistically, most people don't look at this. Alternatively, we look at bridge financing. Bridge financing, there's a few different types of bridge financing. There's more institutional bridge financing. These types of bridge financing are with a bank, whereas there is, on the flip side, there's private bridge financing. There's more like mortgage investment corporation, private capital firm bridge financing. It really depends on your experience, liquidity, location of the building and asset itself. Alternatively, after that, there are some higher or lower debt servicing term debt options with some banks that would require slightly less capital down than you would normally have with a conventional option. And then we take a look at all of the CMHC options that you have available. We got standard 5-year, 10-year, MLI select on the purchase if you want to commit to affordability, or if you want to commit to any sort of energy efficiency off the hop. And we're going to show you all those options to really dial in what is the most effective option for you based off of the strategy you want to implement.
The purpose of us providing so many different options to you is so that you can tailor pick the one that's going to be best for your situation. If you're injecting all the capital to yourself and you're the only person that is going to have to get any sort of return on this deal, you can maybe take more time on the project. Maybe you can take 2 years to be able to get it done, or you can expand it out whether or not, whatever makes sense for you. But if you're bringing on private investors, well, then we got to start working with timelines, and we got to start working with expectations, because we want to make sure that the relationship with you and your private investors is kept safe, because that's what's going to allow you to continue to do more projects moving forwards. One of the biggest things that we see is a misunderstanding of how capital debt structures work, and how the pathway transitions from one structure to the other debt structure, and what those timelines look like. We see a lot of guys in random Facebook groups, or just have some conversations with newer investors, and the conversation is, well, I have investors that want to get paid out in 12 months. And in today's market, a 12-month timeline for a return on an investment to a private investor really isn't a realistic expectation, especially if you're looking to get into CMHC and you have, anywhere from 2 to 3 months, or, maybe even 5 months today with the huge surge in deals they had. So, it's not to overwhelm and over to confuse you. It's to, try to figure out which one of these pathways is going to be the best for you and your debt and your timelines, and who are you working with in your partnerships. And then we can start to sit down and dial in further. Okay, if we're going to go with option A and what that looks like, that's the purpose of it. There's also so many different options in terms of, like, if you're buying a building, how much, turnover do you really need to have to be able to make this deal work? If you're borrowing capital from your investors, maybe you need to have 50% turnover, or maybe it's 75, or maybe you have to turn over the entire building. And when we start to run the numbers and figure out what that equity return looks like, and you have to have 100% tenant turnover, in today's market, 100% tenant turnover is pretty unlikely. The cash for keys cost is going to be absolutely expensive if they're even willing to leave at all. And unless you come across, an absolute unicorn of a completely vacant building, chances are that's not happening. So again, it's trying to set realistic expectations and trying to set those timelines for you so that we can ensure that you're going to succeed in the deal, and not just kind of go in on hopium and just kind of hope the deal works. And then, we're 10 months in and we're nowhere near getting this deal done. So again, it's understanding the pathways and figuring out which one is going to be the best for you.
Completely agree. When we're taking a look at the actual options themselves, a few things we're going to take a look at. One is going to be IR. So if you're buying a underperforming building, a IR, which is an interest reserve, is usually required for bridge debt if you are under 1 DSC, which essentially meaning if the cost of the debt is less than what the net operating income is in the building, most lenders require some sort of interest reserve up front to be able to carry the building until your projected project is going to service the debt. There are a handful of different options available to you. So that's one variable we'll look at. We'll look at fee structure. Some lending options have less fees, some have more fees. We'll take a look at insurance premiums. CMHC Standard has a much higher insurance premium than the MLI Select program. We'll take a look at amortization, cash flow, the most important aspects of why you're investing in the first place. We go over with you initially on the onset, on the purchase, to make sure, again, it aligns. But that's not really the most important thing. The most important thing is, how do we get out of this project? And that's kind of the next step in the process. Is we will show you step by step what options are available to you based off of the increase in efficiency of your building. Now, it's really hard as a multifamily investor. It's really hard to be able to say, well, I'm going to turn over, or I'm going to be able to get 2 units vacant out of my 6 units, or I'm going to get 5 units vacant out of my 12 unit building. Realistically, you can't determine turnover by unit. You're going to have to determine turnover by the variance between the current net operating income versus the stabilized rental income at today's market rent. So what we do is we'll take a look at where you're operating today, where you need to be at for 100% turnover at today's market, and then 25, 50, 75 at 100% turnover increase from where you're at now until then. And what this does is it sets UGI benchmarks for you. It allows you to be able to say, okay, well, once my building reaches this level of efficiency, this is where my refinance is going to look like. So, the product, the turnover, we give you all of your options available right here, so you can make an informed decision as to, is my project viable? Realistically, if you're turning over, you have to turn over 60% of your project to become viable or a good investment for you. We start to ask questions about, is this something that you're looking to take on for the long haul? Do you maybe need to take on a product that has a lower carrying cost and higher equity position on the onset? Really important to understand all your takeout financing options and how they're going to affect your strategy and the type of asset you're buying.
Yeah, and this all depends on, the province that you live in as an investor. Right? If you're in Ontario, Tenant turnover is almost impossible. If you live in Alberta, it's a completely different story, right? So again, everyone is different. Every strategy is going to be different. And the greatest thing about commercial real estate is that it's so easy to be able to reverse engineer the numbers and figure out very quickly, is it going to work? If you're buying a building and your NOI is $100,000 and you need to get it to $150,000, is this doable? Are the rents that you're going to have to achieve in these units way outside market rent? And what does that look like moving forward? Because if we're taking a look at CMHC on the exit, even though you can get leases in place, and if they're 150% of market rent, CMHC is not going to allow you to be able to use those numbers in your valuation. So there's just so many different variables that we have to take a look at, just to be able to run the numbers and ensure that exit is there.
Yeah, the difference between success and failure really is just the preparation you take at the start of your project. Being completely informed and having a deep understanding of how this capital is going to work and what expectations you can have in regards to timeline, cost of capital, moving the debt around. We found that the more informed our clients are, the more successful they become. So, one of the differences with Build is that institutional level financing options are going to be available at every step of the way to be able to allow you to be able to determine whether or not this is going to work or not with all the different financing options available.
I think, based in today's market, it's kind of ever changing moving forwards. We're hearing one thing from the Fed, we're seeing, something else. My point is that, you have to be able to work with someone who kind of understands and is able to navigate the financing world in terms of policy changes and economic changes, and what is that going to mean for your project on a step-by-step type basis. From our experience and from what we do and what we offer, that's kind of our job, is to help you navigate the unknown to you as an investor, and that knowledge gap that's there as an investor, from you looking to get into a project, from us understanding the financing side. That's our purpose. And that's kind of what we set out to do, 5 years ago when we first started shooting our videos, is just bridging that knowledge gap and making sure that you guys understand the steps and the processes and what these lenders take a look at. So from our end, that's all we're trying to do, is just make sure you guys understand all the possibilities, make sure your goals match the actual realistic outcomes with the project and the financing, to make sure that you're successful and you're going to be able to repeat your investments moving forwards.
Yeah, guys, if you guys like this video today, you got some value from it, hit the subscribe button, hit the like button. It allows us to do this, to make videos for you every single week. We appreciate all the support you guys give us. If you did like this video, leave a comment down below, or feel free to reach out to Ehren and I. Contact information is down below. Thanks so much.